The call came in while a cargo ship loaded with U.S. soybeans was halfway across the Pacific, and a quiet alert hit trading terminals in Singapore. China cancels all U.S. soybean shipments effective immediately. By noon, 2.4 million tons were rerouted to Brazil, and by sundown, $1.1 billion in U.S. farm contracts had vanished without a trace. This isn't a trade war, it's a controlled demolition. And soybeans? They're just where the fuse was lit. 40 ships were rerouted and a multi-billion-dollar trade route snapped like a dry twig under pressure. This wasn't a glitch in trade, it was a signal. And it's not just farmers watching, Wall Street is watching, the Pentagon is watching. Because when your biggest customer cuts you off mid-delivery without flinching, you're not in a trade war, you're in a stress test. And America cracked. First, Bloomberg reported that China had abruptly canceled soybean orders from 3 major U.S. exporters, Cargill, ADM, and Bunge, citing strategic procurement adjustments. By the end of that same week, Chinese buyers had locked in 2.4 million metric tons of soybeans from Brazil, totaling over $1.1 billion according to customs data tracked by S&P Global. That volume accounts for nearly 1/3 of China's typical monthly soybean imports. While Beijing did not publicly frame this as retaliation, the move coincided within 48 hours of President Trump's latest round of tariffs on $90 billion worth of Chinese goods. Economists at Rabobank now warn this could be a pivot engineered to dismantle U.S. ag dependence permanently. But is this a short-term chess move or the start of a structural rerouting of global food trade? The fallout on U.S. soil has been immediate and measurable. The USDA's April 2025 soybean report showed a 13% rise in unsold domestic soybean inventories, pushing storage levels to their highest April figure since 2019. Spot prices at the Chicago Board of Trade dropped 8.2% within days, wiping out over $470 million in commodity value in 1 week alone. In Iowa, grower sentiment has cratered. "We've been shut out mid-season with no contingency," said Matt Dunn, a fourth-generation farmer in Des Moines, in an interview with the Wall Street Journal. This is no longer a trade dispute, it's economic isolation. The American Soybean Association estimates the Chinese exit could cut farm incomes by up to 18% this quarter alone. So the bigger question now is, how much deeper does this go? The Trump administration's 20% tariff on Chinese electronics, metals, and EV components announced March 10th was intended to pressure Beijing ahead of trade talks. Instead, the Chinese response targeted one of the few U.S. exports they still relied on: agriculture. And soybeans weren't just any crop. In 2024, the U.S. exported $14.3 billion worth of soybeans to China, making it the single largest export line in bilateral trade. China is hitting Trump's base where it hurts: rural voters and farm states, said Chad Bone, a senior fellow at the Peterson Institute, in a CNBC interview. On April 2nd, the USDA confirmed that farmers in 11 Midwest states are now at moderate to high risk of insolvency due to canceled forward contracts. As pressure mounts on Trump, is this trade war becoming a domestic political liability? Let's pause, not because the story slowed down, but because it just changed shape. This isn't about soybeans anymore, it's about strategy. Brazil's readiness wasn't luck, it was calculated. Between 2020 and 2024, Brazil expanded its soybean acreage by 21%, backed by over $11.2 billion in agri-infrastructure investments. China's state-owned development banks financed grain terminals in Santos, expanded freight corridors from Mato Grosso, and co-funded the Ferro-Grão Railway to cut internal transport times by 42%, according to a report by Reuters in February 2025. This infrastructure built the runway for China's pivot. In fact, Bloomberg Intelligence reports that Brazil now has the capacity to supply 70% of China's annual soybean demand. And with fewer GMO restrictions, looser environmental standards, and stronger bilateral trade protections under BRICS agreements, Brazil's ascent may no longer be temporary. Is the U.S. being replaced permanently? Not just priced out, but planned out? The timing wasn't random, it was surgical. March through June is when U.S. soybean exports are at their most profitable, historically accounting for nearly 40% of total annual revenue, according to USDA trade data. By pulling out now, China triggered a cascading sell-off during America's peak shipping window, undermining both price and volume. Meanwhile, Brazil's harvest wasn't even at full capacity, which means China knowingly paid higher premiums, reportedly $14 to $22 more per ton, according to traders interviewed by the Financial Times. Why overpay? Because short-term losses can yield long-term control, argues Minyu, a trade analyst with China's Ministry of Commerce. In other words, this may have been less about soybeans and more about leverage. But leverage for what? Officially, China cited phytosanitary concerns, quality control issues with fungal residue and pesticide traces in recent U.S. soybean shipments. But as of April 2025, no violations have been confirmed by the USDA or WTO complaint database. In fact, U.S. soybeans consistently meet international food-grade standards with contamination rates below 0.01%, per a joint audit by the FDA and GAFTA. Trade analysts remain skeptical. There's no real precedent for safety-related suspensions without prior warning or inspection delays, said Andrew Tilton, chief Asia economist at Goldman Sachs. By invoking non-tariff barriers, China sidesteps WTO scrutiny while signaling unpredictability to U.S. exporters. So, is this a genuine food safety concern, or a pretext for economic retaliation disguised in regulatory language? How is China turning soybeans into power through ports, railways, and billion-dollar infrastructure plays? China's soybean pivot didn't start at the negotiation table, it started at the docks. Over the last 5 years, China funneled more than $8.3 billion into Latin American logistics, according to the Inter-American Dialogue. That includes equity stakes in Brazil's port of Itaqui, a $1.22 billion expansion of the Northern Grain Corridor, and direct investment into the Ferro-Grão Railway, which cuts transport costs from Mato Grosso by 35%. These aren't just trade routes. They're geopolitical corridors. By embedding itself in the infrastructure that moves Brazil's soybeans, China has reduced dependency not just on U.S. commodities but on U.S.-controlled global choke points. The result? In 2024, over 64% of China's soybean imports came through logistics networks with direct Chinese involvement, according to customs data reviewed by Bloomberg. As one policy analyst at the Carnegie Endowment put it, Beijing is no longer just buying food, it's buying leverage. But here's the question that still has U.S. strategists scrambling: what if food isn't the endgame but the opening gambit? While soybeans dominate headlines, corn is quietly sliding out the back door. Between January and March 2025, U.S. corn exports to China fell 29% year over year, according to the USDA's latest Foreign Agricultural Service Bulletin. Simultaneously, China finalized a 3-year corn import agreement with Brazil's CONAB agency, covering up to 9 million tons annually, worth an estimated $2.66 billion, as reported by Reuters on March 28. This isn't isolated. In March, China's state grain reserve auctioned off 1.2 million tons of U.S. corn, citing price instability and strategic rebalancing. Industry insiders argue the real issue is trust. After escalating tariffs and politicized export controls, Beijing sees American agriculture as unreliable. This isn't diversification, it's insulation, said Joseph Glober, former USDA chief economist, in an interview with the Wall Street Journal. If corn is going, what's next? Wheat? Sorghum? The shift suggests a larger question, one that U.S. markets are just beginning to price. U.S. officials say the door remains open, but Beijing's actions suggest otherwise. According to HSBC's April 2025 Commodities Outlook, China has now signed or renewed long-term import contracts with Argentina, Brazil, Russia, and Pakistan, covering over 70% of its grain and oilseed needs. In contrast, U.S. agricultural exports to China fell by 26% in Q1 2025 alone, cutting $3.2 billion from trade flows per Census Bureau data. Some believe a diplomatic thaw could reverse course, but even if tariffs are lifted, the infrastructure and intent for China's exit is already in place. What we're seeing isn't just de-risking, it's disconnection, said Jennifer Harris, a former National Security Council advisor, speaking to Bloomberg. With political relations gridlocked and BRICS plus expansion giving China alternatives, the question now isn't whether the U.S. can recover market share, it's whether Beijing even wants to come back. Now ask yourself this: what if soybeans were just the first fuse, and the real explosion is still coming? Because this wasn't just a trade dispute, it was a proof of concept. China showed it could abandon a $14 billion U.S. commodity and replace it in 72 hours. No delays, no shortages, no political fallout at home. So what happens when they do the same with semiconductors, with rare earths, with U.S. treasuries? What happens when the next pivot isn't about soybeans but about the dollar itself? That's not just a question for farmers. It's a question for Wall Street and for Washington. Because if this was phase 1, then what exactly is phase 2? Stick around. We're glad you're enjoying this video. Please like and subscribe.